2018 Gold Forecast. Cash and gold pie in the sky. Gold predictions are a dime a dozen at this time of year. Calls for gold to hit $3,000, $6,500, $10,000 or even more. Granted, most of these targets require at least the partial collapse of human civilization to work, although I have seen one or two loosely rooted in esoteric concepts like economics, monetary policy, and central banking. Now, I'd be the first one to line up and sell an ounce of my gold holdings for $10,000, provided the apocalypse hasn't happened, but we can't very well dream our way into profits. We've got to be realistic. Here in the real world, gold is pushing against some stiffening headwinds, although you'll see they're hardly insurmountable. After all, we've reaped tidy gold gains of 11% this year. I've got some great, historical charts you need to see that will prove my forecast is honest. Because, as it turns out, the yellow metal's future looks great from here. Why, you've got to look at the great secular gold bulls. When I was asked to put together my forecast for gold prices in 2018, the charts reminded me of gold's previous secular bull performance. In my view, the gold bull market started back in April 2001, when gold hit a multi-decade low near $260. 10 years later, gold hit a peak price of $1,900. Spotted the Halley's Comet of gold investing pattern that's only appeared twice in 20 years. Click here for details. Then it entered a multi-year correction/consolidation phase, which eventually brought us to where we are today. The naysayers will tell you that gold is finished. Kaput. Gold bears believe we've seen the peak, and it's only downwards from there. But history tells us something very different. A look even further back, at the classic 1970s gold bull, shows a mid-bull cyclical correction that, once ended, helped launch a massive return to bullish action and much higher prices. That was a run for the record books. And you'll see, it's gold's past that helps us lay the groundwork for a reasonable forecast of what it might do in the next year. When gold delivered a decade of steady gains between September 2001 and September 2011, gold managed to produce a compound annual gain of 21.46%. That's what a gain from $272 to $1,900 will do. That's a terrific performance, but gold had pulled off another impressive achievement. During that decade, the highly priced metal managed a positive return every single calendar year. To my knowledge, no other asset has ever accomplished such a feat. But from the 2011, $1,900 peak to the December 2015 low of $1,050, it was nearly a 45% drop. That mirrors very closely the 1974 to 1976 correction that cut gold's price roughly in half, from $200 to $100. From there, gold rose by a phenomenal 800%, peaking at $800, over a span of about 3.5 years. At its current level, near $1,300, gold has already gained almost 24% in the nearly 2 years since bottoming. In my view, we've just recently exited the mid-70s style mid-bull correction phase. And that means, at the cusp of 2018, we're just getting started on the second half of an epic bull market. And here's the proof. Everywhere you look, there's a bullish signal. I recently told you that a rising gold price in multiple major currencies was a strong signal that gold was in a bull market. Here's what that looks like over the past decade. Suffice it to say, gold is up over the last 10 years, and in some currencies, it's dramatically higher. And that includes the cyclical bear market of 2011 to 2015. So I fully expect this bull market to power ahead. Another powerful technical indicator that gold is heading higher is its price chart action. You see, the gold price has been forming a large wedge since 2008. This past September, gold rose above the wedge, reaching $1,350 before pulling back. But it has managed to stay above that line since, and that's bullish. A clear and sustained push above $1,300 should help kick off a new rally to $1,400. That's good news for the folks who own gold. And the folks who get it out of the ground. Buying gold stocks look great. 2 gold stocks relative to the gold price are cheap. Here's proof. The gold stocks to gold ratio reached a dramatic low of 0.15 back in the late 90s, when this sector was bottoming. Yet, In late 2015, the ratio dropped even lower, to 0.1, before dramatically reversing and rapidly spiking to 0.2. It has since pulled back to 0.15, making gold stocks a tremendous bargain. But equally significant is how gold stocks have outperformed gold since both bottomed in late 2015/early 2016. Since late January 2016, gold is up a respectable 15%, but gold stocks have radically outpaced, with a 57% gain. That's a hugely positive sign. When gold stocks rise faster than gold, it typically portends higher gold prices in the future. Look for more double-digit gold profits from here. So, what does all this mean for the gold price in 2018? With nearly 2 years behind us since gold hit a low of $1,050 in December 2015, I'm convinced that we've entered the second half of this secular gold bull market. After impressive gains in 2016, but a more modest advance so far in 2017, I think gold could regain traction next year, once the dollar resumes its downward trend and a long overdue market correction rears its head. In the first half of 2018, I think we can see gold test $1,400, which is just 7.7% higher from its current level. By the end of 2018, I think gold could be closer to $1,475 minus $1,500. That's about 14% higher from here. Russia-China real gold standard means out of US dollar dominance. Interviewing Swiss monetary metals expert Claudio Grass today, Russian government news agency Russia Today signifies again that the Russian government knows all about the Western gold price suppression scheme even if the monetary metals mining industry refuses to acknowledge it. The interview also signifies that Russia, China, and other countries that understand that the United States uses the dollar's reserve currency status to control the markets in the world are working to restore gold to a superior reserve status. Roots interview with Grass is headlined, Russia-China real gold standard means out of US dollar dominance. The BRICS countries are considering starting an internal gold trading platform, according to Russian officials. When this happens, the global economy will be significantly reshaped, and the West will lose its dominance, predicts a precious metals expert. In 2016, 24,338 tons of physical gold were traded, which was 43% more than in 2015, according to Claudio Grass, of Precious Metal Advisory Switzerland. Gold moving from the west to the east. We have to put the BRICS initiative into a broader context. It is just part of a geopolitical tectonic shift which started decades ago. We have seen a constant outflow of physical gold from the west to the east. At the same time, the West has lost the economic war, and as a consequence, the focus now turns to the financial system. China dominates the world economy and has displaced the US as the world's most formidable economic powerhouse, he told Root. The creation of a new gold standard by BRICS is also a step to end the US dollar's domination of the global economy, as Beijing and Moscow understand that America used the dollar to control the world. By implementing a new kind of gold standard 2.0 single quote, they want to distance themselves from this control. Furthermore, the vast majority of the people in Asia sees gold as superior, or real money, something the West has forgotten, because of all the paper wealth, credit they have accumulated, said Grass. The expert notes the BRICS countries account for 40% of the world's population and around 23% of the world's domestic product. In combination with the announcement of pricing oil in yuan, using a gold-backed futures contract in Shanghai, the establishment of the Asian Infrastructure Investment Bank and the New Development Bank, China is setting up an alternative to the post-Bretton Woods establishment. This is certainly a game-changer, said Grass. Physically backed precious metals market spells the end of paper gold trade. The level of trust between BRICS countries can help them establish intragroup gold trading, which would be 100% physically backed. This will present a viable challenger that could over time lead to a breakup of the current system since the West will likely still trade paper gold in the meantime, Grass said. According to London Gold Clearing statistics for 2016, the total trading volume in the London over-the-counter (OC) gold market is estimated at the equivalent of 1.5 million tons of gold. The volume of 100 ounces gold futures on New York's COMEX reached 57.5 million contracts during 2016, or 179,000 tons of gold, the analyst notes. The amount of mined gold is much smaller if we now take into consideration that only approximately 180,000 tons of gold have actually been mined up to today. The scam is just gigantic and obviously unsustainable. The paper scams in London and New York will either blow up when the paper price of gold drops to zero or when just a fraction of investors insists upon receiving physical gold in return, Grass said. The expert believes that with paper gold trading, the established gold exchanges could cease to exist sooner or later. They will likely become obsolete and lose their importance over time. Although one cannot predict exactly how fast this will happen, the trend is clear. OC and COMEX are working toward their own destruction, he said. Gold prices could explode if trading were backed by physical precious metals. It will definitely lead to higher prices for physical gold. Imagine if you could buy on COMEX and OC gold at a much lower price and still have the option to sell it in Asia for a much higher price. This would kill the old paper scams immediately. Therefore, I would guess that both could come up with new restrictions that only cash settlements will be allowed to avoid this. We know, for example, that even today 99.96% of COMEX gold futures are settled in cash, Grass wrote. The final battle, gold versus US dollar. The analyst recollected the heartland theory of Halford Mackinder, a British geostrategist at the beginning of the 20th century who influenced the likes of Kissinger and Brzezinski. Following the theory, we will soon face a war between physical gold and the US dollar. As per my understanding, we are moving into the final phase, the battle between currencies, one that will be backed by a hard asset which was real money since time immemorial until 1971, and the other one, backed by promises that future generations will pay through debt, inflation and ever-rising taxation, he said. Getting away from fiat currencies will be good for gold. I would like to conclude with a final thought from my friend Giant Bandari. The combination of negative yields, massive political risks around the world, and any attempt to move away from traditional currencies will be positive for gold and will take it to the next level. Investing is very much linked with geopolitics. Once you understand the big picture, it becomes apparent what you should invest in, Grass told Root. Decade, the highly priced metal managed a positive return every single calendar year. To my knowledge, no other asset has ever accomplished such a feat. But from the 2011, $1,900 peak to the December 2015 low of $1,050, it was nearly a 45% drop. That mirrors very closely the 1974 to 1976 correction that cut gold's price roughly in half, from $200 to $100. From there, gold rose by a phenomenal 800%, peaking at $800, over a span of about 3.5 years. At its current level, near $1,300, gold has already gained almost 24% in the nearly 2 years since bottoming. In my view, we've just recently exited the mid-70s style mid-bull correction phase. And that means, at the cusp of 2018, we're just getting started on the second half of 2018 gold forecast. Cash and gold pie in the sky. Gold predictions are a dime a dozen at this time of year. Calls for gold to hit $3,000, $6,500, $10,000 or even more. Granted, most of these targets require at least the partial collapse of human civilization to work, although I have seen one or two loosely rooted in esoteric concepts like economics, monetary policy, and central banking. Now, I'd be the first one to line up and sell an ounce of my gold holdings for $10,000, provided the apocalypse hasn't happened, but we can't very well dream our way into profits. We've got to be realistic. Here in the real world, which eventually brought us to where we are today, the naysayers will tell you that gold is finished, kaput. Gold bears believe we've seen the peak, and it's only downwards from there. But history tells us something very different. A look even further back, at the classic 1970s gold bull, shows a mid-bull cyclical correction that, once ended, helped launch a massive return to bullish action and much higher prices. That was a run for the record books. And you'll see, it's gold's past that helps us lay the groundwork for a reasonable forecast of what it might do in the next year. When gold delivered a decade of steady gains between September 2001 and September 2011, gold managed to produce a compound annual gain of 21.46%. That's what a gain from $272 to $1,900 will do. That's a terrific performance, but gold had pulled off another impressive achievement during that epic bull market. And here's the proof. Everywhere you look, there's a bullish signal. I recently told you that a rising gold price in multiple major currencies was a strong signal that gold was in a bull market. Here's what that looks like over the past decade. Suffice it to say, gold is up over the last 10 years, and in some currencies, it's dramatically higher. And that includes the cyclical bear market of 2011 to 2015. So I fully expect this bull market to power ahead. Another powerful technical indicator that gold is heading higher is its price chart action. You see, the gold price has been forming a large wedge since 2008. This past September, gold rose above the wedge, reaching $1,350 before pulling back. But it has managed to stay above that line since, and that's bullish. A clear and sustained push above $1,300 should help kick off a new rally to when gold is pushing against some stiffening headwinds, although you'll see they're hardly insurmountable. After all, we've reaped tidy gold gains of 11% this year. I've got some great, historical charts you need to see that will prove my forecast is honest. Because, as it turns out, the yellow metal's future looks great from here. Why, you've got to look at the great secular gold bulls. When I was asked to put together my forecast for gold prices in 2018, the charts reminded me of gold's previous secular bull performance. In my view, the gold bull market started back in April 2001, when gold hit a multi-decade low near $260. 10 years later, gold hit a peak price of $1,900. Spotted the Halley's Comet of gold investing pattern that's only appeared twice in 20 years. Click here for details. Then it entered a multi-year correction/consolidation phase.